Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. If you missed the first couple segments, we've been talking today about some of the short to intermediate term action that's going on in the market. I know that it's very disconcerting to people, investors, especially retirees, people nearing retirement. At the one end of the scale, I've talked to several young people, their 20s and 30s, and they view this as a great opportunity to be starting out investing, to be able to accumulate investments at relatively cheap prices. Now, we think there is the opportunity for things to get cheaper. We think that certainly not out of the woods yet, that it's going to be a couple of years of these type of choppy markets. But young people generally have a more optimistic view of the future. And looking back on history, I think history will look kindly upon this time to be an investor. Now, if you're within 10 years of retirement, it's a very scary time. Or if you're in retirement or just retired, it can be a very scary time. I was reading something the other day that talked about when you were born and when you started investing, it makes all the difference in the world. And I think people don't appreciate that enough. I think as financial advisors, sometimes we contribute to that problem. Continually saying, well, if you go back to 1900, the average return on the stock market's been about 9%. If you look at England and developed economies, emerging economies, all the data we have, you look at this fact that stocks normally outperform bonds over longer periods of time, et cetera, et cetera. What is so important is that the stock market makes money in bursts. It is not this, smooth ride of, 8%, 9%, 7%, 10%, 11% return. It makes the money in fits and starts. And the time frame that you start is very, very important to your overall wealth. For example, take someone that was born in the 1940s and they were 40 years old or 42 years old in 1982, the start of the bull market. Typically, the mid 40s is when people are accumulating the most wealth or investing the most. And so if you take someone in 1982 that was in their mid 40s and run them forward to the year 2000, they had the greatest bull market in history. And so they were putting money in, they were investing, they were accumulating assets in one of the greatest periods of all time. Similarly, if you take somebody that was born in, say, 1960 and fast forward them to the year 2000 when they're 40 and they're now reaching their peak earning years and they're investing money in the stock market, and they look back at their parents who were born in 1940, say, or they look back in history, they're starting their investment plan in 2000, and they say, wow, what should I invest in? And they look back and they say, gosh, stocks have returned like 18% a year for the last decade. I'm going to put all my money into the stock market in the year 2000. Well, we know how that has turned out. The decade of the 2000 and on into 2011 has been abysmal for someone that was 100% invested in the stock market. And so you can see that the time that you start investing has a huge impact on your ultimate returns. That's why we advocate for a diversified approach. Diversification does a couple things. Number one, it helps remove the possibility of permanent loss of capital, which means that the stock that you own or the bond that you own goes completely out of business. You can eliminate that risk by owning baskets of stocks through exchange-traded funds, mutual funds, or a whole bunch of individual securities. We happen to believe that exchange-traded funds are the best option currently out there. But you can eliminate the permanent loss of capital, unless, of course, you think that the whole United States is going to go out of business or the whole world is going to collapse. And then, there is no hope. But assuming that you think that the world is going to continue on and that some percentage of the companies out there will continue to make money, some percentage of the governments out there will continue to pay interest on their bonds, A diversified approach ensures that you don't put all your money into the most overvalued asset class. Once again, take my example of someone born in 1960. They turn 40 in the year 2000 and they say, okay, time to start investing. And they look and they put all their money in the stock market at one of the most overvalued times in history. Well, a well-diversified portfolio of stocks and bonds and real estate and commodities since 2000 has made a decent return. And so that's one of the reasons for diversification, is to ensure that you don't overpay for an asset class. Now, if you have a reasonable guide to determine which asset classes are overvalued or undervalued, you could overweight or underweight a particular asset class based on those views. But we still think that history has shown that nobody is smart enough at all times and in all scenarios to be able to pick the best asset class or to pick, to be all in cash at this time. Certainly, people are able to do that on a selective basis, but as you look at the Fortune 500 or the Forbes 500 wealthiest people in America, you don't see anyone on that list that has made their money by getting in and out of the market at exactly the right time. Now, we do believe that you should take some risk out of the market at certain times, take some risk out of the bond market, and you should manage the risk profile of your portfolio. But to go all in the stock market or all in the bond market and in and out, there's just nobody that's proven the ability to reliably do that over time. Once again, taking some risk off the table is certainly can be a prudent strategy, especially in a secular bear market. And we do advocate for a risk-managed approach to your portfolio. So to sum up what we've been talking about today, we are still in a secular bear market. I don't see the end of this secular bear market. We do see a nice cyclical rally that if we can avoid a recession going into 2012, the rally could continue. However, with the uncertainty, especially in the United States, over the political climate, we would expect to see the continued volatility in the markets, some declines as we go into 2012, with an ultimate resolution depending on if the economy stays out of a recession and how the election in 2012 goes. So we recommend definitely managing the risk profile of your portfolio carefully over the next year. So that's about all the time we have. So for All Things Money, I'm your host, David Blain. I hope you will join us again next week at the same time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.